Whilst we obviously have absolutely no idea what's going to happen in 2024 in terms of where asset prices are going to be going, one of the key themes that is being priced into markets and being portrayed by markets is the idea that central banks are going to be easing their policy rates throughout 2024. That's certainly going to be welcoming news to a lot of people who have seen very aggressive rate hikes and the prospect of higher for longer, and the market is now challenging that quite aggressively and suggesting that we are going to see both developed market and emerging market central banks looking to ease their policy rates with some vigour. Now, in terms of the timing which is being portrayed into swaps markets at the moment, we can see that the first rate cut, or about 75% chance of the first rate cut, comes as early as May. Certainly the Federal Reserve are pushing back against that and saying it's not in their forecast. But the market has come to the belief that we're going to see the first rate cut coming through in May. In the UK, there's about a 50% chance that we get a rate cut by May, and there's a fully discounted that we get a rate cut by June. In Europe, the market is suggesting there's a 2 in 3 chance that we get a rate cut as early as April, which is quite surprising over the last 30 or 40 years. It's typically the Federal Reserve who will lead the cutting cycle and then the ECB will follow some way after. But in this case, the market is suggesting that the ECB will be the first off the rank. And actually, if we go through to June, there's about 1.3 cuts being priced in from there. The Canadians are also expected to ease policy quite aggressively sooner, and their first cut is being priced in for April. In New Zealand, it's May. And where the outliers really stick out is in Australia and also Japan. There's not really anything being priced in terms of cuts for further well out after 12 months. And in Japan, the market's actually expecting a rate hike beginning of next year to take them out of negative interest rates, and actually 25 basis points over the next 12 months or so, and more over the next 24. So Japan, whilst they move away from yield curve control and the negative interest rate policy, are going the opposite way, which of course is why a lot of people are now getting pretty bullish on the Japanese yen for 2024. Now, if we have a look at 1 year forward rates and have a look at what's being discounted there by way of expectations, we can see a little under 3 rate cuts being priced in the US over the next 12 months, this time up to November. In the UK, we've got a bit over 2 rate cuts coming through. In Europe, 85 basis points or so, which gives us just over 3 rate cuts coming through. So over the next 12 months, the ECB are most expected to be the most aggressive central bank in the developed market or G10 complex. And certainly in LATAM, where they've been easing recently, the market's expecting some pretty aggressive rate cuts coming through from the Mexican central bank. In New Zealand, the market's expecting about 3 rate cuts to come through. And now I think it's really interesting if we have a look at 3-year forward rates to get an idea about where rates could settle or at the terminal lows. The market's saying that we could get down to about 3.6 for the Fed. That's the new sort of base rate going forward. In the UK, it's about 3.8. In Europe, just about 2.5% or so. And in Australia, the sort of terminal price, which they say is a fair price at the moment, is about 4% coming forward. Japan is definitely going to be an interesting one. As we've seen there, they are the outliers coming forward. Now, the interesting situation is why are economists and forecasters suggesting that we are going to get these rate cuts coming through? And there's really 3 scenarios that I'm looking at. One is that central bankers are going to feel really very confident indeed that inflation is gravitating towards trend and actually is with target. We're seeing a cooling of the labour market and we're seeing growth coming down below trend capacity. And in that situation, there's really no need for what they call a restrictive policy rate, and they need to take that down to a more equilibrium status. And more of a neutral rate wherever that needs to be. But clearly, if they leave rates in a deeply restrictive state for too long when the economies are cooling, they can obviously cause greater ramifications. So in central banks, we trust, and they need to, when they get the trigger, move it down to a more neutral state. And I think that's really kind of what we're looking at. The question is timing that rate cut and also the degree coming forward. So I think that's kind of the base case in the markets at the moment. The other situation is if we were to see greater signs of a recession, something that's not perhaps mild, something that's a deep, more protracted, then you would see a situation where they'd need to front load those rate cuts, and you'd need central banks to bring the rate cuts or the policy rate below the level of inflation quite soon. I'm not sure if you're seeing too many people using the rates markets to hedge against that situation. And then the third scenario would be a tail event. Now, we don't know what that tail event's going to be. We could go back to March and look at the banking crisis and say, can we project expect something similar into 2024, maybe a geopolitical event, in which case central banks would not need to just cut interest rates very aggressively and front load them, but also use their balance sheet very effectively, like we've been seeing over the course of the last 5 years. We know that when central banks want to go and use their balance sheet, they can use it very effectively. But on that point, if we go back to the July FOMC meeting, we know that the Federal Reserve are open to the idea that they could be cutting rates in 2024, but also looking to contract and shrink their balance sheet by current pace of $95 billion for QT. And so that should happen concurrently until we get to a situation where bank reserves become ample. And I think that's going to be the situation that plays through. So we are expecting a situation where the balance sheet, or the federal balance sheet, continues to contract under QT, and under a situation where they're going to be cutting rates as well. Now, I think it's interesting if you have a look at this set of assumptions for the US in terms of what we're expecting, or the market's expecting, and the consensus for growth, which gives us this idea of rate cuts. With the Q2, with the current growth numbers on a year-on basis running around 2.9%, we should see that meander down to 1.2% in Q2, about 70 basis points, and getting to a sort of a trough of about 50 basis points in growth there. And that's going to be driven lower by consumer spending, which is going to gravitate lower. So the market's not anticipating a recession, so to speak, but we are going to see a cooling of GDP. And if you have a look at estimates for core CPI, core PCE, which of course is the Fed's preferred measure of inflation, you can see that we do get to below the 2 to 3% target, or in within that band by Q2, and that should remain there going forward. Again, with core PCE within target, it means that the Federal Reserve can look to ease policy. And I think it's also interesting if you have a look at the non-farm payrolls number, which at the moment are averaging about, or the 3-month average is about 204,000. You can see as we go into the next year, estimates for about 50-odd thousand average per month, and also getting down to about 35,000. So clearly, you're getting that cooler labour market. In that situation, if those set of assumptions do come to fruition, then clearly the Federal Reserve do not need to have a deeply restrictive rate, and they would need to take that down just to cause a sort of a more neutral and equilibrium state coming forward. The interesting thing, if you have a look at the consensus for Europe, on the other hand, is that we are obviously in very low growth environment, but people are expecting it to get better. We are going to see growth towards the end of the year in their eyes, and the consensus eyes meandering up to about 40 basis points, which is a bit of a pickup, and we should see consumption ramp up a little bit to that extent. And with inflation still fairly sticky, you can understand why the market's got a consensus view on euro dollar of about 110, 111 by the end of the year. Now, with that in mind, and we look at the idea that we're going to get rate cuts coming forward, the idea is also, if we have a look at what's being priced in, which of these central banks will not live up to the expectations of the market? Which one of these will not cut to that extent? My best guess is it's probably the Federal Reserve. The second situation is will the presidential elections that take place next November have any bearing on Fed policy? They're expected to be vastly independent, but will that be the case? And will that mean that they leave rates unchanged for a larger period of time? And do they leave rates higher for longer in that situation? Again, that could play into the US dollar. The question then also becomes which of these central banks could ease by more than what's being priced into markets going forward. My best guess, given that they are probably the most dovish central bank, is it's the Bank of England. But that, again, could play into that situation. So a lot of questions that take place. The aggressive rate cuts that are being priced in, is it too much? Is it too little? Is the idea that we could get a recession not being priced fully into markets at the moment? The one thing is we know is the market is expecting easing, which will be a relief to a lot of people. The question for us as traders is how does it play into our trading environment, into volatility, into our risk system, into the US dollar and our asset allocation? That's for us to understand. We'll be looking into 2024, and that's for you guys to trade as well.